This is the Forbes Books Podcast, conversations with amazing humans who are impacting the world of business and beyond. Hola, I'm Joe Pardavila, and if you're like me and you love a good comeback story, you're going to dig today's episode. Jordan Belfort experienced a spectacular rise and fall on Wall Street like no other. Coming from a blue-collar background, he amassed hundreds of millions of dollars in the market before serving nearly 2 years in prison after pleading guilty to fraud and various other crimes. But now he's back, and better than ever, as he's rebuilt his life as a speaker, business and sales consultant, and author. Today, we're going to get into what he's been up to and discuss his latest book, The Wolf of Investing. Jordan, welcome to the podcast.
Thank you. Good to be here.
So, Jordan, if you don't mind indulging me before we get talking about the book, if you were to ask any middle-aged guy who you'd want them to play you in a movie, I would say 9 out of 10 will say Leonardo DiCaprio. And you are one of the people that actually had Leonardo DiCaprio play you in a movie. So first and foremost, I'd like to know, what were you thinking when someone said to you, oh yeah, they're making a movie about the book and your life and everything like that, and it's going to be Leo playing you? Were you just shocked?
Yeah, well, I mean, it started off as a bidding war between Leonardo DiCaprio and Brad Pitt, which was pretty amazing, a win-win, right? And they always said, I love Danny DeVito, but it's better than having Danny DeVito play you, right? And yeah, so and then Leo brought Scorsese to the table as well. So it was like this dream team, and it was incredible. I mean, it was, it's something you would never believe would actually happen. And even after they both committed to it, then there's still very, shaky ground. Is it ever going to really get made? They attached themselves to lots of projects, but, it was Leo's passion project. And when it came out, the movie was a huge hit. It was unbelievable. So it doesn't suck, I'll tell you that.
And it's so funny, your ex is in the news recently because she gave Margot Robbie some advice. Did you have to give Leo, because I know Leo's kind of method, did he pick your brain a little bit before?
Yeah, I worked with Leo for about a year, so very closely.
Wow.
It was we spent a lot of time together. We hung out and sometimes hung out and talk socially. Other times we actually worked on specific things and subjects and the sales side. And but one thing I could tell you is Leo really committed to this. I mean, he's incredibly naturally talented, but don't underestimate the amount of hard work he does to bring his best self to a role. He spent, a year preparing for this.
Wow, that's so cool. And so amazing. Your career is just so wild. This sort of like blue collar kid becoming a gazillionaire, going downhill, has some issues with the law, and then all of a sudden you're back and better than ever. I mean, it's almost like there should be a Wolf of Wall Street Part 2 at this point in your life. Could you
Unfortunately, when you're not committing crimes, it's not as much fun to watch on TV. So Leo goes, I don't think they'll make as exciting as your new life is. It doesn't make a great movie because you're not doing anything wrong. I'm sober. I'm not breaking the law. So I do great. But and it's great. Listen, I think it's an inspirational story now. Maybe not be as fun visually, but in the real world, in terms of what empowers people and lifts them up, I think my new life does stand as an amazing testament to that. I think everyone goes through rough times and people make mistakes, and ultimately it's what you do after you make your mistakes. Do you let your mistakes define you, or do you learn from them and grow and become a better version of yourself? And I think that's all you could ever ask of yourself and anybody else, is to try to continually become a better version of themselves.
That's awesome. And becoming a better yourself in the world of Wall Street. So I always like to make random metaphors and analogies of things. So you're probably a football fan. Tony Romo. When Tony Romo retired, his next year, he was broadcasting games on CBS, and he was predicting plays. They called him Romo-Damas or whatever it was, because he was so attuned to the sport because he just retired that he knew the formations, the plays that were going. But now you jump 5 or 6 years later, he's no longer doing that because the game's evolved. It's different. The formations are different. There's more shifting and motion and all that stuff. So he's not doing that. So the reason I bring this up tying into you is Wall Street's a lot different than when you were the Wolf. So
yeah,
did you have to, in essence, retrain yourself with how Wall Street works because so much had changed since you had went away and then came back, roaring back?
It's interesting that you say that, but, Wall Street is a unique animal into all other things, because picking stocks is unlike anything else. And it's always been a sucker's game, and it's still a sucker's game. And I think the one thing that really has changed since I left the business, and I still invest personally and do some venture capital, because I wasn't actively owning a firm, right? is that information now is in the hands of everybody, and the platforms now exist that anyone can trade directly. You don't need a broker to trade. There is all sorts of things now, like, high frequency trading, and stocks don't trade in eighths and quarters anymore. They trade in decimal points, volumes much higher. You have a whole crypto, which is just like penny stocks of old. The irony is that it's exactly the same game as it was back 20 years ago, 40 years ago, and 60 years ago. The difference is now is that Wall Street used to have an excuse to say why you needed them, meaning the retail side, why the retail investor needed Wall Street to go place your trades, because you couldn't do it yourself. Now, you literally don't need that anymore. You could actually go onto a platform and, with a press of a button, you can do it all yourself. And frankly, the best trade for the last 100 years has been the S&P 500, the index. Now, before 1976, you couldn't even buy it. That was an issue, but that was changed by Vanguard, right? So since then, Wall Street's almost been, actively for the first at least 30 years, suppressing as much as possible the fact that index funds are by far the best bet in town. They just are. Historically, the best bet. They beat mutual funds. They beat 99% of hedge funds. In any year, you can have some hedge funds beat the S&P, but over 5 years, they don't. They start to collapse. Only a very small handful do, and those few are not open to the average investor. So I think that, Wall Street, it's easier now than ever to make money, but you're adhering to the rules been around for 20, 30 years, which is long-term investing, buy the index, don't try to time the market, don't try to pick individual stocks. Human beings are lousy stock pickers by nature. They usually sell when they should buy and buy when they should sell. And all the fancy derivatives and all this sort of stuff, unless it's in the hand of uber professionals, it's usually going to end up with severe tears for the average person. So the question is, how do you roll it up into a strategy that you can explain to people? That's why I wrote this book was, it's so simple to make money on Wall Street over the long term, but it's really boring in most books to read about. So I wanted to write a book that was funny and exciting and sort of, gave you the history of why things are the way they are. But at the end of the day, you walked away with the right strategy.
Interesting. And so when you developed the playbook and you quote unquote cleaned yourself up, for lack of a better word, was there a transition period where you're like, and especially once people started seeing Wolf of Wall Street and reading about the old salad days, but did you have to convince people that not only were you this larger-than-life figure who was successful, but you also knew your shit? Was there a transition period for you to convince people, and all these consulting gigs that you've taken on over the last few years? Was there an adjustment period for the street to be like, oh shit, Jordan really does know what he's talking about. He's not just sniffing cocaine off hookers and stuff like that. He knows his way around Wall Street.
That wasn't the challenging part. That was very easy for me. I think more was about, like, do you trust the guy? The guy that did that, right? I think it took time to earn people's trust, and it didn't happen overnight, but it's been, God, the thing is, the movie happened, 10 years ago, but the events in the movie happened 30 years ago. It was a really long time ago, right? So over the last, I would say, in the last 15 years, I've worked very hard to do the right thing, give massive value to my clients and so forth. And I think I've earned a really great reputation among them. And the idea is to, give massive value to people, and you get them the results, and they're willing to pay for that. So, that's the exchange versus just trying to make money without giving value.
Now, you've not lost your rebellious streak. You still have it, because in the book you write about, and you say it cleanly, that you should never pay for an expert to manage your money. I don't know about you. That doesn't sound like good advice. Jordan, what are you talking about? What do you mean you don't hire an expert?
Well, I think that, I stole that from Warren Buffett. So he's pretty smart, So, and I credit Warren Buffett for that in the book. So I think Wall Street, in fact, I know this to be true, which I don't think it is true. Wall Street's the one exception to the otherwise basically steadfast rule about seeking out experts to get the best results possible when you want to do something. So I'll give you a few examples. If your pipes break in your house and you're leaking water, you're probably better off calling a plumber than trying to fix your own pipes. You'll get a much better result.
Right.
Worth the money to spend on a plumber. Same thing goes if you have an electrical short. You should definitely go hire an electrician to fix that short. Don't try to fix it yourself. You'll probably kill yourself, right? So you pay the electrician, you get a good result. If you're sick, you need surgery, well, I'd advise you to go hire an expert surgeon who's been to medical school and residency and doing surgery for 20 years and paying whatever his fee is on top of the insurance, because if you try to operate on yourself, you're going to probably end up in a bad way, right? It's true for all things, except Wall Street. Wall Street's the one example where you give your money to an expert and you don't get back enough value to justify the fees they charge. In fact, it creates a situation where they almost have to create activity to justify that fee, which causes, more losses, more taxable events, higher fees and commissions and so forth. So you don't get the value on Wall Street from an expert. They can't beat the market. So, you end up, and if those that can beat the market, barely, when they deduct their fees and commissions and whatnot, you end up behind the 8 ball. So like even last year, I mean, listen, Ken Griffith is obviously a genius, nothing to say bad about the guy, but, his best fund did what, 20%, if you take I think after his fees, he didn't beat the S&P, his best fund of all, did not match the S&P. And most of his funds did far worse, and he had a good year. Right now, some years he does beat the S&P. He's the best in the business, and his best funds are probably close to the average investor. But 99% of hedge funds, they can't beat the S&P.
And one of the things, too, you talk about experts is identifying not only the value that you're not getting, but also when they take advantage of you. Are there sure signs for folks that are not as well skilled as you to realize that, wait a minute, something's hinky here. What's going on? I feel like I'm being taken advantage of.
Well, I mean, I think the first telltale sign is any expert that advise you to get involved with complex products and to have you shifting assets constantly, going from one asset class to another, engage in short-term trading. Those are telltale signs. Another one is when they want to steer you into their own house proprietary products. Now, it's not necessarily bad, but very often, if you're just being steered into the house products, you want to do some research, you might find out that the other products that are not offered by this company have better fee structures and features that are more aligned with you. So I think you got to be really careful when someone from XYZ firm is recommending XYZ firm's in-house products, or when you get, even in real estate, if you look at one of these limited partnership deals and you find out that, there's a lot of inside dealing, they're selling properties to themselves through sister companies, and a lot of the stuff is disclosed. But they put it in the fine print, or, the fee splits are just outrageous. So, these are all telltale signs. But in the market, the big ones are the ones I mentioned, lots of trading, shifting asset classes, and house products are really typically the smoking guns.
And so for house products, so I got my stuff tied up in Fidelity, and Fidelity has their little funds and stuff like that. Is that not that you're saying they're doing any ill will towards Fidelity?
No, not at all. Again,
like that, right?
Here's an example. Let's say you're Fidelity and they're your person that you go to for your investments, right? And they have an S&P 500 index fund. You look at the cost, the fee structure on that, and the annual expenses on the fund, right? And it's called the expense ratio is the exact terminology, right? And then you go look at Vanguard and you find out that it's 10 times higher than Vanguard. I'd be very, very wary. Then you say, why the hell am I giving my money to Fidelity when Fidelity could go ahead and buy Vanguard's fund? The reason it's a bad example is because Fidelity has a really good S&P 500 index fund.
Oh, good.
Like their expense ratio is very low.
Good.
Okay, but not all of them are like that. So most of the S&P 500 index funds are, except for the really egregious ones. I mean, how do you justify charging a hefty fee when you're just mirroring the market? But some of them don't mirror the market quite as well as others. So you want to go, in the book, I list a few of the better ones, right? This becomes a lot more important when you start dealing with in-house insurance products and annuities and stuff like that, or sector funds. And suddenly it gets a bit more opaque and you realize that, it might sound really good, but after you do more research, you'll find out there's a very similar investment that has a much lower expense ratio, less commissions and whatnot. And you got to be really careful about that.
Nice. Well, I like that I'm getting some good free advice from you here. Don't send me a bill after this is done, Jordan. But
I will.
You also talk a lot about mutual funds and EFTs, which is something I'm also involved with. Good, bad, worse, and different between those two?
They're very similar. I mean, listen, there are advantages to each one. ETFs are very easy to buy and sell because you buy and sell them like stock, right? So, they can buy them and sell anytime the market's open. Mutual funds are a bit different. You can't really, you have to wait till the end of the day to execute the trade. You got to go back to the issuer of that mutual fund. It's a bit more complicated, but there are some mutual funds where they allow you to automatically reinvest dividends, while other ETFs don't. So it really depends on your own, personal, what's the most important to you. But generally speaking, they're very, very similar.
Okay, good. And I know you mentioned crypto earlier. I think, didn't they just start a ETF for cryptocurrency or something that you can invest to? It doesn't sound like you're bullish on crypto, but what do you think about when it's in relation to an ETF?
No, I like Bitcoin a lot. I've had my love affair with it. I hated it, back when it was first coming out. I thought it was a scam, and it was, I think, in the beginning, and it became real. But I think now it's very decentralized, and it's real. I think it's going to go much higher over the long term. I don't know where it's going next year. Who knows, right? But I think over the long term, I think it's got good, the fundamentals behind it, in the sense that, the limited supply and so forth, the way it's decentralized. I think it serves a purpose as a store of money. And I think that, with some of the technical things, like with their having the fee paid to miners and stuff like that, I think are bullish. And I think it's clearly, this ETF, is clearly a bullish side, because it's the first time really you can, have your money safely in custody with one of these, with a BlackRock or something. So I think that's really a big step in the right direction. So I think there's a lot of tailwinds there. Outside of Bitcoin, I'm very skeptical still. Ethereum, I think, is real, but I'm still not quite sure what the use cases are going to be for all this stuff. But Bitcoin's, I think, a really good store of money.
Cool. Yeah. And on that, because I've always felt the argument, and I never wanted to be anti-crypto or pro-crypto in a way, but I always would listen to the arguments. And I remember the pro-crypto arguments were, oh, well, it has no relation to current economy. It's its own world. It has, if the economy goes down, Bitcoin will not go down. Well, 2020 rolls around, and you see that once the tightening of the economy happens, then Bitcoin and a lot of these other cryptocurrencies go down. And as I read into it, it was basically because people treated crypto as essentially a stock. It was just something that they would take a flyer on and invest on. But that's not what they envisioned cryptocurrency to be, Jordan. You know that. They wanted it to be a sort of a replacement of the dollar. So talk to me about those arguments for and against crypto, where it was like, hey, listen, we're going to be, no matter what happens in Greece or the United States or Asia, we're going to be fine. And it turned out that wasn't the case.
Yeah, well, I think that's a trajectory Bitcoin is on. Eventually it will probably get there and be more of a really safe store of money that doesn't, really follow the market so closely. But yeah, for sure. What happened was it was trading like a growth stock and a very volatile growth stock. And it's just like a shotgun effect, when, interest rates are dropping, money's, flowing into riskier assets, right? When interest rates are rising, people say, well, I can get the safety of bonds, and money flows out of those riskier assets. So it's really a risk on, risk off situation. I think Bitcoin got caught on the ass end of that equation. So it was a risk off mentality. So money flowed out of all risky assets into more, let's say less risky assets, especially bonds and, high quality stocks. But also on top of that was a massive fraud going on in all these, whether it was, FTX or Binance or tokens and the NFTs. So it was a sort of giant bubble, and there was a lot of it was fueled by money printed by the Federal Reserve during, and during the pandemic. So, all these things that really caused the pump in Bitcoin to, get to this crescendo. And I think that, in hindsight, it was pretty obvious that at some point it had to crack. I don't think anyone was that surprised, really. But I think that this time around, I think it's going to probably do the same thing. It'll run up again and crack at some point, but probably less severe. Each time gets a little bit less severe. But I think ultimately, as it's really more institutionally sponsored, it probably is going to get less volatile. It's always going to be volatility in it. But I think that over time, as it gets into stronger and stronger hands, I think it smooths out and stops trading less like a growth stock and starts trading more like the way gold would trade.
And in terms of functionality, are you in the camp, it doesn't sound like it, but I'll ask, are you in the camp that you can see people using Bitcoin for random transactions, like buying items, buying a car, whatever? Or
I don't think
you see it like gold?
I don't see Bitcoin for that at all. I think that maybe stable coins are good for that. But Bitcoin to me is a long-term store of value. I don't think it's really designed. It's not efficient. It's too expensive. Maybe Bitcoin Cash, but I just don't think that Bitcoin itself is ever going to trade like a currency, so to speak, more like a store of value. Maybe I'm wrong.
I mean, there are countries, I think South America, I can't remember which one it was, like they made their official.
El Salvador, but they're a tiny country. I mean, it's more of a PR thing,
All right. And you mentioned risk. Let's talk about risk and your relationship with risk calculus, because as we mentioned at the top, the whole world knows that you took a lot of risks outside on your own. But, obviously business is different. How has your risk calculus evolved as you've matured and you've learned from your mistakes? Are you more conservative than you used to be, or do you still play with a little risk when it comes to investments?
I still risk I will always, have risk in my life because I love risk. But obviously I'm more conservative, and I, will be play with a certain amount of money that I can afford to lose. So, right now, I'll put $100,000 into something very risky, but I wouldn't put $1 million into something risky, but I'll full flyer into something risky.
So it's almost like you have like that gambler's mentality of like when they say, how much should you lose when you go to the casino? Well, enough for like what you would ever spend on a night out. That's what you use. That's how you almost see like your investments in a way, that the stuff you can live to lose.
Let's just say I'm not going out there and gambling, so to speak. I try to do it in a more educated way, but I go into it knowing that I could lose if I'm going to, invest in a VC deal. I mean, I'm aware I'm going to have a good shot of losing all my money. But obviously, I'm trying to pick good ones, or if I'm, making any early stage investment, always thinking along those lines. But yeah, I think that you need to accept the fact that when you invest in that sort of early stage company, you have a good shot of losing all your money.
Yeah. And you know what I find fascinating from the Wall Street world to the venture capital world is the mindset in VCs is it's almost like a spaghetti against the wall kind of thinking. Just throw as much crap against the wall and hopefully a couple things stick and then we win. It's almost like a batter's average in baseball. If you hit 3 out of 10, you're a Hall of Famer, but that you're still striking out 7 times. So
right.
Tell me about that mindset.
That's the end result, but you're trying to make everyone a winner. Like you're not buying when you're throwing shit against the wall, but not because you think it's shit. You think they're all great, but they end up turning into shit. So it's sort of like you would never invest in. Oh, let me just throw out. It doesn't matter if it's good or bad because it's just a numbers game. No, that's when you really do your best and try to only invest in the very best of things. You're still going to hit 7 dogs along the way. It's a very difficult thing to do. So it's not about like throwing shit against the wall is not really the right metaphor. It's really like you're throwing gold against the wall and the gold's turning to shit, most of it, and hopefully if you think stay gold.
and it sounds like you are very much diversified. You're still investing in Wall Street. You have VC. Is there anything else that you're very bullish about these days in terms of like another quiver in your arrow case, whatever the hell that metaphor is? Like, is there something else you're super passionate about, like real estate?
I'm passionate about AI right now. I think AI has got some tremendous opportunities. I really
do. And yeah. How do you see that? You see that in terms of like you're trying to get in ground level in these companies?
Well, in the sense that I think there are some great use cases in the world of sales where you could. I think it's still not, the technology's not quite there yet, but maybe another year or so will be there where you could actually have the AI, instead of a salesperson on the phone handling a lot of stuff, and they'll never lie, they'll never get sick, they never go off script, and I think you get a really good result out of that. So I think I'm in the process of trying to build some stuff right now that can ultimately replace some salespeople.
And all right, so that's the sales side, but how about the management side? Could there one day be an AI financial planner that can 10x your investments? Do you see that in the future?
No, because it won't last. Because once one has, they all have it, and it's the rush to to get the edge will evaporate when maybe for like someone will have it for a short time, but very quickly that gap will close because that's what the market is. It's efficient. So if it becomes everyone gets better, then everyone gets better, and the gap closes. It's an arbitrage. It will only last for a very short period of time. If AI gets more efficient, it's battle the AIs until the gap closes, because that's what markets do.
So are you bullish in investing in companies now, or are you just still waiting till that? You mentioned the technology improving in a year or so. Are you jumping in now, or are you sort of slow?
No, if I see good deals, yeah, I'm jumping in now. If I see good deals,
is it risky to get in now, or do you think now's the time to get into AI technologies investing?
Now is definitely the time. I mean, you want to get it as early as possible. There's going to be a lot of dogs in there as well, but it's again, being in with the right network of people, seeing the right deals, then you got to spread, and you can't put too much in one. You got to do a bunch of them.
Does this give you feels though of the dot bomb though? the fact that all these people are going to start investing in all these companies, all this money on paper, and then all of a sudden one day it's kaput, because that's what happened in 2000.
Yeah, of course it's going to happen. That's human nature. So it happens with everything. It's not just then. It's always, like the next greatest thing, right? What's the next bubble everyone's going to chase? What's the hot money? Where is it, right? And yeah, it's going to happen. And it's already happening right now. Thinking about a bubble, you don't really know when you're in the middle of it. It takes a little while to figure that out, And everyone's like, oh, this time is different because this time it's artificially intelligent. It's, yeah, okay. It always ends up the same way in the end. You have hot money that all flows into one sector and it bids it out. There's no end, and suddenly, boom, one thing happens and everyone starts rushing for this. It's the same story every time,
That's awesome. All right, so I want to pick your brain and get some more free advice, because right now, if the experts were right a year ago, we should be in the middle of a massive recession, but we're not. What happened?
Human beings are really, really bad at projecting these things. They just really are, And I think that kind of what I talk about in the book is exactly that. It's like, if you listen to CNBC, you'll go crazy trying to, the market's going down. We're heading into a recession. Who knows? You really don't know. I mean, maybe they get a sense of what the next quarter is going to be, but I don't think the markets work like that. And a lot of it has to do with interest rates. Not it's not just about, is the market in a recession or an expansion. And, there's a lot of macro factors, geopolitical factors. We're also going to an election year. But I think the solution to that is to not listen to the noise, is to block out the noise and do it and buy for the long term. I don't know where the S&P is going next year or the year after, but I can tell you in 10 years, it's going to be higher, 99.9% sure.
All right, you're currently living in Florida. What's that like? What is life like for Jordan Belfort these days? Because for most people, they just saw the end of Wolf of Wall Street and they said, oh, okay, cool, the guy, after all that, he survived and he's alive. But paint a picture for us. What is the life of Jordan Belfort like now down here in sunny Miami?
Well, I'm married. I have children who are older, and I have a grandchild, and I have a beautiful place down here, and I travel all over the world to speak and consult, which is great. No more drugs in my life, things that make sense when you're in your 25, 30 years old don't make sense much when you're older, right? But I have a great life, and I'm very fortunate for that. And I respect that I got the second chance and made the most of it. So, but I have a great life. I have a lot of fun, a lot of great friends, great dinners. And Miami's a boomtown.
Yeah, that's what I hear. And you mentioned you have kids and they're fully grown now, but just out of curiosity, since we started talking about Wolf of Wall Street, and when that movie came out, we're like, oh, Dad, really? I mean, we all know not all of it is true. It's all Hollywood, but like there's a grain of truth to all of it. What was your family, especially your kids' reaction when that movie came out?
Well, it's more of a grain of truth, and it's very accurate, actually.
Oh, okay, all right, good. Well, I didn't want to assume anything. But
no, I mean, my kids were older. They were already in their, in college, and they just, they were very proud of me that I had Leonardo DiCaprio playing me in Scorsese. And by then, I had come back from the whole thing and was traveling the world. So they knew me for the man I had become, not the insane character I was in the movie. So they were very proud of it.
That's awesome. And now the future of Jordan Belfort, when you run into people, and they see what you've become, living your best life in Miami, and you're just a completely different person than what you want. What do you want to convey to folks when they run into you in the street now? Obviously you've made a life now of trying to help people become better at investing, becoming better at with their money. But the people that are running into you now and see what you are, it's like two different human beings. So let's wrap this up by saying, who do you want people to know Jordan Belfort as?
For me, the greatest part is that I serve as an inspiration to everyone who's going through either a difficult time or is trying to succeed and thinks the deck is stacked against them, or they've made some mistakes and they want to rebuild, and they look at my life and say, wow, this guy, he hadn't really lost everything, would have killed most people, but he came back. Look at his life now, and it really gives them hope, and it gives them their own wherewithal to know that if they do the hard work, because I worked hard, and they do the right thing, they can rebuild and get whatever they want. Like, it's never too late to come back.
Awesome. His name is Jordan Belfort. The name of the book is The Wolf of Investing. Jordan, thanks so much for the time. Really appreciate it.
My pleasure. Take care.
And that's going to do it for another episode of the Forbes Books Podcast. You can always connect with me on X, LinkedIn, and Instagram at Joe Pardavila or TikTok at J Pardavila. Thanks for listening. Until next time, adios.